The stock market just reached an all-time high, but nearly all of that growth can be attributed to just a handful of companies. Collectively, they are known as the Magnificent Seven. The Magnificent Seven refers to seven US technology-focused mega-cap companies that have driven a large portion of the stock market's gains over the past several years. This elite group is made up of Apple, Alphabet, Microsoft, Nvidia, Facebook, Amazon, and Tesla. Together, these firms represent about 1/3 of the S&P 500's total market capitalization as of late 2025. They utilize upward trends in AI, cloud computing, digital advertising, and the adoption of consumer technology to power their growth. And boy, have they grown. In 2015, the combined market cap of these companies was around $2.2 trillion. Now, it's nearly $22 trillion. That's 36.2% of the entire value of the S&P 500, supposedly 500 of the most valuable companies in the world. This is a graph mapping the gains of every company in the S&P besides the Magnificent Seven since 2005. And this is the Magnificent Seven. Even as other large cap stocks seem to be stagnating, the market has shown no end in its confidence in these companies. So, who are these tech titans? Why is there such a significant gap between them and the rest of the market? And what does that mean for our economy moving forward? Let's find out. Each of these companies rose to power through a different wave of technological change that built on the one before it. In the 1980s and 90s, Microsoft and Apple laid the foundation of personal computing. Microsoft by powering the modern workplace with Windows and Office, and Apple by redefining design and user experience with products like the Macintosh. In the 2000s, the internet created the next wave. Google revolutionized how we access information, and Amazon transformed how we shop, ushering in the age of e-commerce and data-driven logistics. The 2010s brought the mobile and social revolution. Apple's iPhone put a computer in everyone's pocket. Meta turned billions of people into daily users of its platforms. And AWS, Amazon's web service, quietly became the backbone of the internet through its cloud infrastructure. And that brings us to our most recent wave. In the 2020s, Tesla and Nvidia became the final additions to this elite group. Tesla, with its autonomous technology and electrified transport, and Nvidia, with the chips that now power nearly every major AI breakthrough. Each wave layered on top of the last. Hardware feeding cloud, cloud feeding data, and data fueling AI. Until these seven companies weren't just part of the market, they became the market themselves. Although each of these companies took a different path to the top, one thing unites them: investment in AI. Over the past couple years, AI has been revolutionizing the way we work, think, and create. It has propelled companies like Nvidia into this elite group and has forced the tech establishment to adapt or die. This realization has caused billions to pour into AI in recent years. Companies like Meta and Apple have each announced plans that could exceed $500 billion in AI-related spending and infrastructure by 2028. And they're not alone. Every one of the Magnificent Seven has made significant investments in AI. In September of this year, Nvidia announced a strategic partnership with OpenAI, committing to invest up to $100 billion as OpenAI deploys millions of GPUs in their new data centers. But it doesn't stop there. Microsoft has spent at least $9.7 billion to get its hands on Nvidia chips for their own AI expansion. In its essence, this creates a cycle where companies like Microsoft pour money into NVIDIA, who pours money into OpenAI, which itself is integral for Microsoft's AI goals, in a big loop of big tech funding itself. Still, no matter how much money these companies seem to be spending, their market growth dwarfs it. Need I remind you of this graph from a couple minutes ago? The market is pricing these stocks as if their growth is endless and inevitable. The price to earnings ratio is a fairly standard metric for evaluating stocks. A PE between 10 to 20 is fairly normal. 20 to 30, a little overvalued, but could have high growth potential. The average Magnificent 7 PE? 69.3. Now, it is worth noting that this number is a little misleading because of Tesla's behemoth 293 times price to earning. Even still, the PE of the other six averages out to 39 times earnings, indicating a high chance of overvaluation. Some say this looks an awful lot like a bubble. But let's dig into some reasons why these companies might be experiencing such high market confidence. Well, these companies are where they are for a reason. The Magnificent Seven generated over $500 billion in profits in the 2024-2025 fiscal year. Most of them provide consistent double-digit revenue growth, high margins, and enormous free cash flow. This leads investors to treat them as a safe bet, with a rare mix of stability and expansion potential. The prime example of this is NVIDIA, which saw its revenue more than double this past year to $130 billion, with profit margins north of 50% and an operating income that jumped 147%. Its chips have become the literal backbone of artificial intelligence. Every major cloud provider, research lab, and AI startup depends on NVIDIA hardware, giving the company a monopoly-like grip on one of the fastest-growing sectors in the world. On that note, now is a good time to bring up that although I'm generalizing these 7 companies as a single group, they are all unique, having separate strengths, weaknesses, and future potential. For instance, Apple aims to control the entire user experience, from hardware to software and services, with a focus on premium design and user experience, whereas Microsoft focuses on creating widely compatible software and platforms that run on a vast range of devices and partner ecosystems. And I'd be remiss if I didn't bring up Tesla, in many ways the black sheep of the group. As we saw with their PE ratio, Tesla has much weaker fundamentals than the other 6 members, and its market success can largely be attributed to growth potential and its controversial founder. Still, compared to the rest of the market, all 7 of these companies have a lot more similarities than they do differences. When taken as a whole, the Magnificent Seven all have incredible fundamentals and significant margins. But, as their PE ratios show, despite great earnings, the market is pricing them well above even their stellar fundamentals. That brings us to another reason why their valuation might be so high: expected growth. The price to earnings ratio only accounts for the present, but these companies could be primed to experience an AI-driven boom. The price to earnings to growth ratio takes a company's price to earnings and provides a forward-looking valuation based on 5-year earnings per share growth estimates. While imperfect, since these growth estimates might be flawed, it can serve as a better metric for these high-growth tech companies. 1 is considered a baseline. A PEG below 1 is undervalued, and above is overvalued. The Magnificent Seven have a PEG that is 3.4 times earnings, 2.4 if you discount Tesla. So, even with growth accounted for, these companies are still trading at well above their fundamentals. That leaves one more possible reason for the exponential stock growth that these companies are experiencing. It might actually just be a bubble. We have reached a point where investment into AI and these 7 companies have become so obvious that the market appeal has outgrown what it should be in a rational world. A September 2024 McKinsey report found that retail investors held 30% of Magnificent 7 shares compared to just 18% for the rest of the S&P 500. And one can imagine that this effect has only continued since then. Seemingly everyone with a couple $1,000 and a Robinhood account is bullish on these blue chip behemoth stocks. And why shouldn't they be? They are the leaders in an AI revolution, have great balance sheets, and their stocks just keep going up. But many investors only look at the quality of what they are investing in and completely neglect if they are getting it at the right price. The narrative that the stock market and these 7 companies always go up is becoming increasingly commonplace. And that unbridled confidence and fanciful speculation is when you know you are in the midst of a bubble. This isn't the first time we've seen a trend like this. In the mid-20th century, the US stock market was going through one of the most extensive bull runs in history. A large portion of this growth through the mid-60s to early 70s can be attributed to the Nifty 50, a group of 50 large-cap stocks on the New York Stock Exchange characterized by their consistent earnings growth and high PE ratios. Think Coca-Cola, IBM, and General Electric. During the period of 1965 to 1972, the Nifty 50 grew roughly 400% compared to 90% in the rest of the S&P. The Nifty 50 coincided with a period of economic expansion and innovation, marked by the emergence of mainframe computing, consumer brands, and post-war affluence. Due to this, they were seen as one-decision stocks, meaning you could buy them at any price and hold them forever because they were supposedly unstoppable businesses. Yet, the Nifty 50 traded at an average price-to-earnings ratio of 40 compared to 18 for the rest of the S&P. Sound familiar? Despite their magnificent growth, the 1973 to 1974 bear market crushed them. Many of the Nifty 50 fell 60 to 80%, even though their earnings held up relatively well. So, could this be the fate of the Magnificent 7 too? The answer is, we can't know for sure. But indicators certainly point in a similar direction. Companies like Apple, Nvidia, and Google are bolstered by strong balance sheets and solid business plans, meaning that their earnings and growth potential are likely to remain stable regardless of what the market says. Their stock price, however, has no such safeguards. Whether it be the Nifty 50, the 90s to 2000s tech bubble, or the Magnificent 7, all good things must come to an end. As we've seen, the market is pricing these tech giants at an insane premium, and at some point, a correction will be imminent. It's near impossible to predict exactly when this will happen. But when it does, its effects will ripple through the market as a whole, because when 7 companies become the market, it takes just one misstep to shake the entire system. Is the price of the Magnificent 7 justified? How much more can they grow? And is a market correction going to happen sooner rather than later? Let me know your thoughts on the current state of the market in the comments section below, and subscribe if you want to see more content like this.